morning and welcome to another live technical analysis. Starting off with the euro against the US dollar. So, from a fundamental point of view, we are seeing that following Fed Governor Waller's comments, the US dollar appears to be gaining overall, in terms of its counterparts. So for the euro, appears to be moving in a downwards fashion. Now it's below our R1. It has not broken below our S1 level of 1.08250, and as such, we would still maintain a bearish outlook as long as it manages to break below S1. Next potential target could be S2 at 1.07250. Lastly, S3 at 1.6200. So we should speak about Fed Governor Waller's comments yesterday. Essentially, he's been saying what most Fed officials have been saying for the past month or so, that 6 rate cuts may not occur during this year. Essentially, they're going to be cutting rates at a slower pace, therefore pushing back market expectations of 6 rate cuts. Now, that in theory could be attributed to the dollar strengthening. Essentially, the possibility of 6 rate cuts not occurring provides some support for the US dollar. And as such, for the pair, we would maintain a bearish outlook. Now, for the euro in particular, ECB President Lagarde earlier on today at the Bloomberg House in Davos implied that the bank has reached its terminal rate, yet could wait before cutting rates, or may do so at a lesser rate than what is expected by the markets, and that markets may be over optimistic, which may not aid the ECB's inflation target. So, slight rebounding of the ECB president's comments, but overall, we would maintain a bearish outlook for the pair from a technical and a fundamental point of view. So, the RSI at 37 still implies a bearish market sentiment, and as such, we could see a small market correction to test R1 at 1.0905 before the pair continues moving in a downwards fashion. The Bollinger Bands have widened, implying high market volatility, yet overall would still maintain a bearish outlook for the particular pair. Moving on to the British pound, it's bounced off the 1.2610 level. So this could have been RS1, but essentially it bounced off. Now, as we said, the dollar gained, yet the CPI rates for the UK economy came in hotter than expected, implying persistent inflation pressures in the UK economy. And since the CPI print was higher than what was expected, the markets might be readjusting. So this 4-hour candle was formed following the CPI rate, following the release of the CPI rates. Such, we're seeing that the British pound may be gaining. Now, overall, I would be removing my R1 and would actually readjust our support and resistance levels as well, perhaps for a more macro time frame. Now, we could maintain our sideways moving channel, but we just need to readjust. Let's draw this again, taken from this point, extended. So you have 3 touches validating a sideways moving channel. Now, the upper bound could be brought around at this previous high here. This could have been perhaps market correction to stay within the channel boundaries. As such, we will maintain a sideways bias for the pair, dropping RR1 slightly lower as well to reflect the upper bound of the resistance line, 1.2785 for R1. Then you have R2 at 1.2900. And for R3, taking this previous high at 1.2999, as we had mentioned yesterday. Not 199. 1.29995. That's actually slightly lower, so let's just bring this 0. So you have R1, R2, R3, and support at S1, S2, and S3. For now, maintaining a sideways bias for the pair, following the CPI rate. So from a fundamental point of view as well, RSI came back up to 50, so sideways between S1 and R1. Should it break below S1, would switch to a bearish outlook, whereas should it break above R1, we would switch towards a bullish outlook. For the dollar against the Japanese yen, aiming for R1, 148.350, continues to validate our upwards moving trend line that we had formed on the 2nd of January. Such, we will maintain a bullish outlook for the particular pair. Note for tomorrow, Japan's CPI rates are due to be released. Now, according to economists, they're expected to show at easing inflationary pressures in the Japanese economy. In such an event, we may see the US dollar gaining against the Japanese yen, moving higher, potentially even breaking R1. But for a bullish outlook to continue, would have to break above R1 and then aim for R2. Now, the Bollinger Bands, the mid range appears to be coinciding with our upwards moving trend line that we had mentioned moments ago. So, for a bearish outlook, simply breaking below S1 would not be sufficient. Would have to break below our upwards moving trend line as well. Next potential target being S2 at 144.85. Next target 143.40. For the Australian dollar, now the GDP rates for the Chinese economy for Q4 were released earlier on in today's Asian session. The GDP rates came in slightly lower than expected by 0.1%. Yet that may be concerning in terms of China's economic resilience. Now, it did come in higher than the previous rate, but still lower than expected, weakening Aussie given their close economic ties. Such, we would maintain a bearish outlook for the particular pair if it manages to break below RS1 of 0.65350 that we had actually placed yesterday. As a matter of fact, note how this bearish candle wicked down towards support level, touched, failed to break, but the RSI running along the figure of 30, bearish market sentiment, and I would expect it to potentially break below S1 before aiming for S2 at 0.63500. Next target, 0.6170. So for now, we would maintain a bearish outlook for the pair based on China's GDP rates and downwards moving trend line, and from a technical point of view as well. But it has to break below S1. Moreover, in tomorrow's Asian session, we're noting Australia's employment data, expected to showcase a loosening labor market. And in such an event, we may see the Aussie further weakening. If it breaks below S1 today, during today's trading session, before the release of the employment data, it could come back to S2. Whereas, should the employment data showcase a resilient labor market, we may see the pair reversing course and aiming back for R1. Therefore, for a bullish outlook, it would have to break above R1 and then aim for R2 at 0.66865. That would be our resistance line at R2. Moving on to the dollar against the CAD, we're seeing that the US dollar is gaining against the Canadian dollar, partially due to the comments made by Fed Governor Waller. Now, the bullish candle tried to wick up. It just missed our R1, so it indicates that there could be potential resistance at this point. Now, we would still maintain a bullish outlook despite this bearish candle being formed. And let's say this bearish candle breaks below our upward swinging trend line. I would still maintain a bullish outlook. Look at the RSI figure, still running along the figure of 70, implying a bullish market sentiment. We had a crossover of the moving averages. Bollinger Bands appear to be tilted towards the upside. Therefore, would maintain a bullish outlook as long as it does not break below S1. So if it corrects down to lower ground and then continues moving up, that would be okay. But for a bullish outlook to be maintained, it would have to break above R1. For a bearish outlook, simply breaking below S1 would be sufficient. Next potential target being S2 at 1.3315. In terms of gold, now one could say that it might also be moving in a relatively sideways fashion. Now, if we draw a sideways moving channel and then simply extend, tight range between the 2016 S1 support level, R1, 2055. RSI tilted slightly towards the upside. It's at 38, so there are some bearish market tendencies, yet it's bouncing off near S1, so could correct and stay in between this range. Sideways bias for the precious metal as long as it remains between S1 and R1. Narrowing of the Bollinger Bands also imply low market volatility. Whereas for a bearish outlook, it would have to break below S1, 2016, and then aim for S2 at 1,973. For a bullish outlook, it would have to break above 2,055 before aiming for 2,088. Now, oil is an interesting story. We're noting the increasing tensions in the Middle East, but this time It's not the Houthi rebels in Yemen, it's Iran and Pakistan. Iran has apparently fired missiles into Pakistan targeting a terrorist group. But why is that interesting? It showcases the high level of volatility within the region. As such, should they continue, it could increase the price of oil. Yet, for now, we're seeing a bearish candle, potentially due to concerns from China. Given that China is the world's top oil importer, a slowing in economic growth or a potential slowdown, as such, with the GDP rates which came in lower than expected, which may be concerning, could also imply that demand for oil might be reduced. As such, could weigh on oil prices as we may have been seeing. For today, it's moving in a downward fashion as well. Now, this would not be entirely sufficient for a bearish outlook. For a bearish outlook, it would have to break below S1 of 69.95. Whereas for a bullish outlook, it would have to break above R1 at 74.85. For now, it's broken below our upwards moving trend line and had previously broken above our downwards moving trend line. Therefore, I would switch for a sideways bias between S1 and R1. Forming a sideways moving channel right now would be slightly difficult given that my S1 is at 69.95. I would like to see the commodity come to S1, failing to break below S1 and then moving higher. And then I could potentially place a sideways moving channel between R1 and S1. For now, though, I would maintain a sideways bias, narrowing of the Bollinger Bands, low market volatility. They appear to be straightening it out. Therefore, sideways bias between S1 and R1. Looking at the S&P 500 as well. So on the daily, it's moving in a downwards fashion as well. Now, should the hawkish rhetoric from Fed officials continue, as this is not the first time that we've seen a hawkish rhetoric emerge, we may see the S&P 500, the Nasdaq 100, and Dow Jones 30 move in a downwards fashion. For the S&P, it would have to break below S1 of 4,700, next target 4,600. For a bullish outlook, breaking above simply from 4,816 would be sufficient. Now, I've noticed that the Dow Jones 30 has broken below our S1 level of 37,295. So let's drop down to 4-hour chart and let's readjust our support and resistance levels. Let's see, let's zoom out. It's broken below S1. So next potential target for the index could be at the 36,770 level, or something that's slightly in the near term could be at the 37,100 level. So 37,100, that would be our new S1. And let's readjust our text tables as well. And let's make this slightly easier to place on the chart. And then for S2, taking this previous higher low, 36,400. That would be my new S2. And then for S3, we could keep it as it is, 35,725. So I have S1, S2, and S3. Now for resistance, I would keep my R1, R2, and R3, but we could bring R1 lower. But based on how the Bollinger Bands are, so the upper band of the Bollinger Band is touching on R1, I'd like to keep them as they are, at least for now. We could readjust them at a future point. But for now, we're going to be keeping our resistance levels the same. So you have R1, R2, R3. And then we have our new support levels with the exception of S3. For a bearish outlook to be maintained, it would have to break below S1, aiming for S2. For a bullish outlook, simply breaking above R1 would be sufficient. But the RSI is running along the figure of 30, and as such implies bearish market tendencies for the Dow Jones 30. Looking at the Nasdaq 100, still moving in a slightly sideways fashion between S1 and R1. RSI is still above 50, but near 50, so slightly sideways. Bollinger Bands are no longer tilted towards the upside, might be flattening out between R1 and S1, so sideways bias. But if the Dow Jones continues on its downward trajectory, that could be concerning for the Nasdaq and the S&P 500. As such, we would closely monitor the Dow Jones 30. Let's see what else we can have a look at. New Zealand dollar moving in a downward fashion, broke below S1, so 0.613 is support now turned to resistance. So I have my new R1, I have R2, and then I have R3. Next potential target for the bears, 0.6015. Further than that, we have S2, 0.5895. And then looking for S3, previous higher low, 0.578, 0.5790, rounded up. So we would maintain a bearish outlook for the pair. As we said, the dollar appears to be strengthening. RSI running along the figure of 30, implying a bearish market sentiment for the pair as well. Now, looking at some stocks, we can have a look back at Morgan Stanley and Goldman Sachs. So, if I'm not mistaken, Goldman Sachs slightly exceeded their earnings expectations. Some support. We could readjust our support level at S1 slightly higher. Note the 2 wicks and then a third validating a sideways moving channel. You have 3 touches and you have confirmed once, twice, and thrice. So I would maintain a sideways bias for the company stock price between the range of 373.97 and 388.75. So S1 and R1. Now we could slightly bring S1 higher, 351.0. Then you have S3, 334.50. RSI near 50, so sideways between S1 and R1. Bullish outlook, simply breaking above R1, then potentially aiming for R2, whereas for bearish outlook, simply breaking below S1. Morgan Stanley, it temporarily broke below S1 of 85.60 that we had placed yesterday. So this was a gap that was formed. Now, one could also say that another gap has also formed. So let's just see if we can indicate this. So this appears to be the wick of this bearish candle. So its high was at 88. This is a temporary line that we're placing. We're going to be inserting a shape, so a rectangle, which could indicate the gap that exists. And I expect this to potentially be filled at some point in the future, so it may come back up. Note how the opening of this bullish candle is resting on RS1, so it appears to have validated that this was support. In the event that in today's trading session the price action breaks below S1, we would switch towards a bearish outlook as well, aiming for S2 at 79.10, S3 73.85. But if it moves higher to fill in this gap and then continues moving lower, we'll still maintain a bearish outlook. So for a bullish outlook, it will have to break above R1, not simply move to fill this gap that was formed. For a sideways bias, staying between S1 and R1. But for now, I would be maintaining a bearish outlook. Personally, I would expect it to potentially come back up to test that this is a gap, partially fill it in before moving lower. But that remains to be seen. In terms of Tesla, having a look, appears to be continuing its downward trajectory. Now, this might be prudent for us to readjust our downwards moving trend line, tilting it slightly, so readjusting it. Bollinger Bands tilted to the downside, RSI 30. Bearish outlook for the company stock price, aiming for S1, 208.70. For that to continue, it would have to break below S1 before aiming for S2, 193.90. Bullish outlook, simply breaking above R1 and then aiming for R2. I have BNP Paribas, Societe Generale. On general comment, I would be placing much emphasis on these speeches in Davos. So in particular, the ones provided by Bloomberg at the Bloomberg House. Those are pretty interesting and would be nice and could actually have some impact on the markets as well. If you look at our Twitter account, excuse me, X account, we tweeted what ECB President Lagarde had said earlier on today. Now, ExxonMobil, a personal favorite of mine, once it broke above our downwards moving trend line, sideways. Our side still near 50. It's validating S1. If it breaks below, bearish outlook. It fails to break below, sideways pass. Note that how the Bollinger Bands appear to be tilted to the words sideways between S1 and R1. If we also add the CCI indicator as well, commodity channel index, at this point may have been appears to be resting on the minus 100, so it could stay in between S1 and R1. In particular, useful when stock or perhaps an FX pair is moving in a slightly sideways fashion. One could use the CCI. Boeing, as expected, Boeing continues in its downward trajectory. So you have one, a second, and if we see a third gap as well, that could be an exhaustion gap. So this could be a breakaway gap, acceleration to continuation, and then a last gap could be the exhaustion gap before it turns around. But for now, breakaway, continuation gap, one more, and that could be the exhaustion gap. For now, though, we would maintain a bearish outlook for the company stock price. Note how it opened on S1, so it failed, it broke below, so this would be support now turned to resistance. Now, this is a pretty difficult, I wouldn't say pretty difficult. Yeah, we need to find R2. Like having R2 here could be far too close to R1, so we need to readjust slightly higher, 122.10. Then I'm going to be keeping R3 144.50. That was the breakaway gap. S1 196.65, but based on how it's been moving, we could erase S2 and actually move it even lower in case a similar event occurs. 176.30. Let's remove RS2. And then, since we're looking at it from a more macro perspective, I would personally place S3. I'm looking at this wick. When it managed to break down, it moved lower, tested that this was resistance, and continued to move lower. Once it broke above, it moved higher. As such, 160.60 would be a valid support level at S3, in my view. So you have S1, S2, S3. Could be due a small market correction higher, but based on the way it's been moving, I would expect the company stock price to continue declining. Airbus, breakaway, continuation. This could actually be an island reversal as well. Let's see how that plays out. We've done UBS. Well, we haven't done UBS. Could look at Amazon. Before we do that, let's see if we have missed something that we should have gone over through. S&P, Schlierer, Deutsche Bank, Australian, Aussie JPY, Intel. We could look at Nvidia and Intel as well before we do Apple. JP Morgan, IBM, General Electric, Philip Morris. Let's see. Nvidia. Chart window. Our predetermined template. And properties, let's remove the grid lines. For our time frame, let's look at it on a weekly basis. Very nice. Daily, gap up. All right, so let's prepare our NVIDIA chart. First glance, too far away. Potential support 538.25. I'll zoom in so that you can see as what I'm taking the closing of the bullish candle, the opening of the bearish candle, and then it moved higher. You could either take this, but personally, I have two touches, and as such, 538.40, potential S1. Now for S2, hold high, swing high around here, validated by this wick, 504.10. That's my S2. Then for S3, a low. Validated on numerous occasions, 1, 2, 3, 4 times, 454.10. That's my S3. For resistance, one could say, if you take this wick here, 568.25. But for this to be an actual resistance level, I'm going to go back and check that this was a prior resistance level. So let's zoom out. And here we go. Yes, this used to be a resistance level for a stock split. But is it prudent for us to take R2 when S1 and S2 are that close? The answer is no. Much better to take a previous high, which is a bit closer. And then for R3, we could take this high. So when we come back, you can see 612.4 for R2. Yes, the distance between the two is significant, but the way it's been moving and from a more macro perspective, this could be a significant resistance level. S1, more of a temporary, longer term, and then S3. We're going to be adding our indicators as well. 648.40, that would be R3. Now for indicators, we could add RSI, Bollinger Bands as well. So the standards, Bollinger Bands, high market volatility, tilted towards the upside, could be bullish, but maybe due market correction. So for a bearish outlook, breaking below S1 and S2 from a first glance. Let's add something else as well to validate our theory. I'd like to put Bill Williams, but for now, let's just add the basics. RSI 78 could be overbought. Small market correction lower, but overall, bullish market sentiment. Upwards moving trend line as well. From a more macro perspective, moving higher. Bullish outlook for the company's stock price, at least for now. Would have to break above R1 for it to continue. Next target being R2. Let's also look at Intel. I think we have skipped. Oh, there we go. Intel for our chart. Let's clear everything and add them again. 4 hour. 45.60 for S1. Now, we've set up for NVIDIA. Let's look at Intel. Intel appears to be narrowing. Note the Bollinger Bands, note the RSI, 50. So there appears to be some divergence from NVIDIA. So for now, it might be a different story for Intel, at least temporary. This could be your S2. Swing low, validated by a wick. Also around $4 in difference between S1 and S2 could be sufficient enough to counter for a potential or unexpected move. As such, from a more macro basis, you could have S1, S2, 41.18. Then for S3, you could take where this gap occurred, 34.70. Now, for resistance, this, so 48.45 could be your R1 and could. It's close to S1, so it could easily be broken. But for now, we have R1. Then for R2, 51.15, although it's actually a bit close to RR1 comparison to the distance between S1 and S2. So perhaps we should, or we could slightly readjust. Note how the support found at this area, I'm going to be putting a circle on now. Note this area here. At this point, there appears to have been support found. And then when it came back down, came back up, tested, bearish candle, closed, moved lower. Therefore, this could potentially be a resistance level at R2, so 51.65. For R3, I take it slightly higher. So previous higher low, 53.28. That's okay for an R3. But compared to S3, it's actually not. So it needs to be higher. Actually, perhaps at this point, previous high, coinciding with 1, 2, a third, a fourth, and a wick from a fifth and a sixth candle. So it appears to be a valid resistance level, 54.70. There we go. So you have 54.70, 51.65. Now, I wouldn't say up. I wouldn't be bullish for Intel right now. I'd maintain a sideways bias until I see a clear indication of it moving above R1. So you would have to break above R1, fill this gap, and move slightly higher for it to be a bullish outlook. It's coming back down, so it might be low market volatility as well. For a bearish outlook, simply breaking below S1, 45.60. Next target, 41.18. So for now, sideways. But I would keep a close eye on the stock price. In terms of technicals, you could say that this is a downwards moving trend line. And this could actually, it's a descending triangle. Clear break below 3%, breaking below our S1, and then perhaps aiming for S2. But I wouldn't say that it's bearish. I'd say sideways for now. I'd like to see a clear indication of something else happening before I take a bullish or a bearish outlook. So sideways between S1 and R1. Moving on, we have Lockheed Martin, Johnson & Johnson, BNP Paribas, Sociedad General. We could do, let's do UBS. UBS is an interesting one too. All right, so we have UBS for our time chart, for our time frame. S1, 1, 2, 3, 4 candles, so 29.18. Appears to be a valid S1 level. So let's just fix the text labels as well. 29.18. That would be S1. For S2, taking this point, gapped up, validated by wick, so support 23.37 or 35 if you run it down. 27.35, that would be S2. Then for S3, same concept as before, managed to gap up, then and again, and then 1, 2, 3. So this could have been an exhaustion gap, breakaway gap if it gaps. But this is the issue with stocks. If it moves and opens lower, then it could be a continuation gap, which could indicate a bearish outlook for the company stock price. But for now, that remains to be seen. 25.45. We'll have a look at UBS tomorrow as well. I'd like to see how it moves today, and then we'll come back to it in tomorrow's live technical analysis. For now, though, I place R1 between these 2 points, 30.25 as my resistance level at R1. Then for R2, taking it's too close. I was going to take that high, but it's a bit too close to R1, considering the distance that we are keeping for S1 and S2. Would not be prudent for us to place. Okay. Now, in such a scenario, I have no other alternative. Well, since I don't have historical data, that high is my R2. But for R3, we're going to have to extrapolate. So the distance between, let's say, S2 and S3, let's say it's roughly $2. So it'd be at 32, which is also a big figure. But if we place it at 32, it's too close. $33. It's slightly random, yes. I don't disagree with that, but it's a big figure. And what we could check is the distance between S1, so 187, 166. 187 would be 33.15. But given the psychological aspect, 33 could be a valid resistance level if it breaks above R2, not 31.2, 33.00. So we have R1, R2, R3. Appears to be tilting towards the downside. If it breaks below S1, I would immediately switch towards a bearish outlook. If it doesn't, sideways, and then lastly, bullish, but it has to break above R1 and move towards R2. This is 31.30, not 30, 31.30. So have R1, R2, R3, S1, S2, and S3. So if it breaks below S1, bearish outlook. If it doesn't, sideways bias. And with that, that does it for today. Thank you for watching, and I'll see you tomorrow.
Everyone, my name is Emily. We've already looked at margin level and margin call level in our previous videos. Today we'll be looking at stop out level. The stop out level is when the margin level falls to a specific percentage in which one or all of your open positions are closed automatically. This happens because the trading account can no longer support your open positions due to a lack of margin. Basically, the stop out level is when the equity is lower than a specific percentage of your used margin. If this level is reached, your broker will automatically start closing out your trades, starting with the least profitable positions in order to free up margin. The stop-out level is calculated according to the specific level set by the broker, your trade size, leverage, and equity. If the stop-out level is set to 50%, this means that once your equity falls to 50% of your used margin, then a stop-out will be triggered. The easiest way to avoid unexpected stop-outs is by applying good risk management techniques. For example, you can set stop losses, limit exposure, and you can also top up your account equity to increase your margin level. Hope you found this video useful and stay tuned for more educational videos. Thank you very much. Bye-bye.
I think we'll go ahead and just get started. So, okay, let's get started. So, as per usual, a risk warning and disclaimer. So, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here is our agenda for today. So firstly, we'll go through which timeframes you should use for swing trading. And then we'll look at some graphical key elements, followed by identifying momentum. So this will be pretty similar to last week's momentum, where we talked a bit about the different indicators that you can use to identify the momentum. And then we'll look at breakouts versus reversals, as well as using correlation to fine-tune your strategy, because that tends to be pretty useful when you are looking at swing trading. So just let me know in the chat if there are any of you guys who like to use swing trading. I'm just curious to know as well. Okay, so here is a clear market structure example. So this is kind of the structure that we're looking for when we are going in for our analysis or choosing which timeframes to use. And this is an example for an unclear market structure, an example that we want to kind of stay away from. Okay, so which time frame is the most important? For swing trading, okay, so before I get into that, just want to show you guys that the more important thing is to look for clear market structures. So you can see on the M15 here, it's pretty unclear market structure, whereas on our H1 view, it's pretty clear shape. Yeah, so there's two criterion here. Firstly, we want to look for a clear swing low or clear swing high. And secondly, we want to look for a clear trend between the starting and ending point. So this can be used for support and resistance levels. If you're using pivot points indicators, that works as well, and even your Fibonacci levels as well. So for which time frames to use for swing trading, these tend to be on the higher time frames. So 1 hour to about your daily time frames. So like yeah, so H1, H4, and the daily time frames as well. Those tend to be used for swing trading. Yeah, but as I mentioned, it's more important to look for clear market structures when you are determining which chart that you want to use. So I'll just do a really brief introduction to multi-time frame analysis. We went through this last week, but if you weren't here for our previous webinar, which was on day trading, I'm just going to briefly talk about this in this slide. So typically, traders will choose at least two time frames, such as a shorter term time frame and a longer term time frame. So it's basically a strategy that involves analyzing the market um, from multiple time frames so that you get an idea of the general trend of the whatever commodity or currency that you are trading. So the short time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall market direction. So you want to look for key resistance levels, trends, and patterns. And these tend to involve looking at your indicators, looking at your Fibonacci levels, so on and so forth. So, for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. So, conversely, if the longer-term trend is bearish, the trader may look to sell or short the market. As also if the shorter term trend is also bearish, then you would know that there is an indication of a strong downtrend in the market. So overall, multi-time frame analysis tends to help traders gain a better understanding of the market and gain more informed trading decisions by analyzing the bigger picture and trends and patterns from multiple time frames. Okay. So what exactly should you look out for? So price action wise, okay, these are obviously some of the basics that you should look out for on the higher time frames that you use for swing trading. But of course, in terms of price action, we're talking about past, present, and future momentums from the previous bar to dictate your strategy. So that brings us into our next point, which would be identifying momentum. Okay, all of these are kind of just tools that you can use to identify momentums and key levels. So the first key graphical levels, horizontal levels includes like your support, your resistance, and these tend to be supported with your Fibonacci levels, and including looking for Fibonacci confluence areas, so on and so forth. But we'll get into breakouts as well as Ichimoku clouds in the next few slides. And if we have time, I will also show you guys how exactly you can use these on an actual chart. Okay, so here, let's go through a couple of momentum indicators. So firstly, we have the MACD, and the MACD stands for Moving Average Convergence Divergence. So this line is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. So the signal line is a 9-period EMA of the MACD line. Okay, so basically it uses three exponential moving averages to identify price movements. And the difference between these averages is shown in a histogram, which you will see in the next slide, which is just the charts. And then, the graphs. And then the movement can show whether a trend is strengthening or weakening. However, moving averages always lag behind price action and are more suitable for identifying entry points. So the MACD triggers technical signals when the MACD line crosses above the signal line to buy or falls below, which is a signal to sell. So here is the example of it, just so that you get an idea of what I'm talking about. So the MACD line is the blue line, signal line is the orange line. The histogram that I mentioned earlier is just your bar charts or graphs over here. And then your zero line is, of course, just the dotted line there. So a selling signal occurs when the MACD line crosses over the signal line. And then the bullish or buy entry is over here. So when the signal line crosses over the MACD line. It's just the opposite of here. Okay, so this is an example, and our sell entry is over here as well. So basically, you just want to take note of each of the crossovers because that tends to indicate a change in trend or change in direction of movement. Yeah. Okay, but it's important to note that these tend to be lagging indicators as well. Like you can see over here, only when price has shown a reversal, then the next few lines, then we see price crossing over and indicating. So basically the red area indicates a sell. So this, yeah, it's pretty much a lagging indicator. So just keep that in mind if you're intending to use your MACD. Okay, let me know if there are any questions throughout the webinar. Okay, next momentum indicators, we're going to look at RSI as well as stochastic oscillator. So RSI oscillates between 0 and 100. Values above 70 are considered overbought, and values below 30 are considered oversold. So when the RSI value is above 70, it suggests that the security may be overvalued and due for price correction, potentially indicating a sell signal. And when the RSI value is below 30, it suggests that the security may be undervalued and due for price rebound, potentially indicating a buy signal. For stochastic, the readings above 80 indicate that price is near its high, and readings below 20 indicate that prices are near the lows. A security is overbought when the K line moves above 80 and oversold when the K line moves below 20. So here is an example for stochastic. So how we like to use stochastic as well as RSI is by looking at hidden resistances, divergences as well, which we'll get into in a little bit. But we do have webinars on purely on divergences, so you could go and take a look at those as well. But I'll briefly go through those now. So what we mean by a hidden resistance is that on our stochastic, we see that we have multiple swing highs that line up nicely at this 93.52 line. And on our price chart, we have price making a higher high at each of these lines over here that we've highlighted. So this is what we mean by hidden resistance. And then we can expect price to continue to respect this level here. Okay, here's another example of a hidden support or resistance. So we see that we have, and once again, we are using a stochastic indicator. So we have a hidden support level in this case, and on our stochastic, and on our price chart, we have this increasing trend line. Okay, so just to recap, what makes a valid trend line is if there are 3 significant touches, and you can see that we are expecting price to continue to respect this line because firstly, we have this ascending trend line, secondly, we have a hidden resistance here. Okay, and you can see that's exactly what it did, pushed it all the way to our take profit. Okay, so over here is an example of how we are using multiple indicators. So here we have the trend line, that's the first indicator. Second indicator, we're using the stochastic hidden support level. And we are also using our horizontal levels, so support and resistance levels, swing highs and swing lows to basically to find confluence and analyze or forecast that our prices are going to rise to our take profit level. Okay, so I mentioned earlier a bit about divergences. So here is the first example, which is a bearish divergence. So bearish divergence happens when an RSI or stochastic has a descending trend line, or descending or descending. If it's bullish divergence, then that would be ascending. So so here's an example, whereas on our price chart, we can see that price is either respecting a horizontal resistance or it is making a higher high. Okay, so in this case, we see that price is making is respecting a horizontal level. Okay, first point, price is testing a key horizontal resistance level with price making a smaller high, resulting in bearish divergence with RSI. Whereas on our RSI, we have a descending resistance line, which is basically descending trend line, and it caught the two reversals correctly, which you can see on our price chart. So what this forecast is that we could be seeing a reversal here as well. Okay, and you can see that's exactly what happened. Price reverses strongly because of the horizontal resistance, RSI resistance plus bearish divergence. And we can see that the RSI has also reversed very strongly. Okay, here's another example. Here is a little bit more straightforward. So we have price making a higher high and our stochastic making a lower high. Okay, and yeah, you can see that immediately after this divergence, price immediately dropped on on our price chart. Okay. So this is an extension of the previous example. In this example, we see price immediately drop, but we can see that it's rising again and it's approaching our resistance level here. So it's approaching this resistance level and we see a repeated pattern with the ascending, or rather price making a higher high and stochastic making a lower high. So it's the same pattern. We also have a hidden resistance level between these two swing highs, and you can expect price to continue to drop, which is why we call it a bearish divergence. And that's exactly what happened over here. Okay, divergence potential. So in this example, we see that we want to take note of where the bearish divergence started. So that's why you place a vertical line over here, as well as where we intend it to approach. So in this case, we see the bearish divergence making a higher high from this level to here, whereas our RSI is making a lower high from here to here, which is why we place our vertical dotted lines at these areas. Bearish divergence tells you that price is making a higher high, RSI is making a lower high. So we also highlight this area because price tends to reverse to the previous level where it started to diverge. So this is also basically a pullover in this case support level. Okay, because we see that price is expected to pull back to this same level here, pull back or retrace back to this level. And you can see that's exactly what happened here. Price reversed to where the divergence started to occur. Okay. Now, forecasting breakouts. We see this ascending trend line and on both our price as well as our RSI. But on our RSI, we can see that price has recently broken out of this ascending trend line, which forecasts that price might we might observe the same thing over here. And you can see really close, if you look really closely, that price is barely breaking out of this ascending trend line, but also shows strong recent bearish divergence versus RSI. So we have a couple of pointers here that support our analysis that price is going to break out of this ascending trend line. Firstly, we have the RSI breakout over here. Secondly, we have the bearish divergence with price making a higher high and RSI making a lower low. Next, we have price breaking out of this ascending trend line here. And all of these points suggest that there is a high probability that our analysis that price is going to break out of this ascending trend line is actually going to happen, which you can see price broke and dropped strongly. Okay. Here's another example. In this case, we are seeing a descending. Okay, well, this is not a descending trend line because, as I mentioned earlier, we need 3 points for it to be considered a valid trend line. But this is a descending resistance line because we see these two swing highs on our price chart, and we also see the same two lines at the same spots for our RSI. Okay, so we see that our RSI is breaking out of this resistance level. Yeah, it's breaking out of this resistance level, and that's a suggestion or forecast that price is going to break out of this descending resistance as well. Okay. Okay, so price is now testing the descending resistance line. We're wondering if it's going to break it. Secondly, we have a descending line breakout, as we mentioned earlier, but we also have a bullish divergence. So bullish divergence is basically the opposite of a bearish divergence. So we see that price is making a higher low on our RSI, and on our price chart, it's making a lower low. That's basically bullish divergence. So when you draw it out, it should look like this. Okay, so it suggests that price is going to continue to go upwards and break out of this descending resistance. Next, let's move on. So now we are looking at how we can play the continuation or breakout and reversal. Okay, so this is just a checklist for you to follow, especially if you are a beginner trader. It's just a good checklist to take note of a couple of things or check for a couple of things when you are doing your analysis. Okay. So firstly, we have playing the continuation. Next, we're gonna look at playing the breakout. Okay, but we're looking at continuation first. So firstly, we want to see is price respecting Ichimoku. Secondly, is price respecting any trend line. Thirdly, is there any key horizontal support resistance level, Fibonacci levels that support these levels, and where's the next key level that it might go? Okay, so in this example, we are looking at a trend channel. So it's very obviously an ascending trend channel. What makes it valid is if there are two touches on top, two touches below, and you can see that it's continuing. So we are playing the continuation. What we mean by bounce and reversal in this case is not so much a reversal in trend, but more a reversal in terms of touching the walls of the trend channel. Okay, we see bounce off of the trend channel. That's basically what we mean by bounce and reversal in this case. not so much breakout of the channel, and that's why we call it a continuation, because it's still continuing within the trend channel. So it's still moving within the trend, the ascending trend. Okay. Next, up on the other side, we are also looking at a descending trend channel just in the opposite direction. So we also see it bounce off of the walls of the trend channel just in a downward trend. Okay. Next, let's look at playing the breakout. So when we play the breakout, we mean crossing below the Ichimoku cloud, um, whether the momentum is in accordance to your analysis. Did price break any trend line? Did it break any recent key horizontal level? Or key Fibonacci confluence areas? And where is the next level that it could break out to? And then we fine tune it with Fibonacci levels and support and resistance areas. Okay, so in our first example, we are playing the breakout from this multiple swing high resistance. Okay, these tend to be areas more so than specific levels, which is why you can see that we've highlighted this area here. Okay, so price has broken out of it. We are expecting it to continue moving upwards for a couple of reasons. Firstly, we have this next swing high resistance here at the 135.147 level. Second point, we see it moving above the Ichimoku cloud, so suggests that it's a bullish signal. And then thirdly, we see that we have a 78.6% Fibonacci projection that also lines up with that same level. Once again, it doesn't have to line up exactly at the same level. I mean, it would be nice if it did, but these tend to be confluence areas more so than levels. So as long as it's near or close to it, that's fine. Okay, you can see that's exactly what happened here. So we moved above the 61.8% Fibonacci projection and move next, rise next to the next swing high resistance. Next, we have, in this case, a descending trend channel. Okay, so when we say breakout, you see it moving, still moving within the descending trend channel. So that's playing the continuation. But what we mean by breakout is you can see it's breaking out this ascending trend line. Okay, and it's also moving just below, or rather it's breaking out of the Ichimoku cloud. Okay. So we see this swing low support at the 1.03488 level, and we're expecting price to continue to drop to that level, which you can see it did nicely here. Okay. Next, playing another breakout. In this case, it's breaking out of the ascending trend channel. So in this case, we are using an inverted Nike tick or a Fibonacci extension. So for Fibonacci extensions, we look for ticks, or Nike tick, or basically anything in the form of a V shape, as long as the tail of the V shape is longer than the head of the V shape like you see here. Okay, so in this case, it's kind of inverted. So we see the 127.2% level. That's where price is at now. And the 161.8 is at this swing low support here at 0.66420. So we're expecting price to break out of this 127.2 and continue heading towards our 0.66420 level. Okay, and in this drift, you see that price it does test the 127.2 level a little bit, but you see that it ultimately does break through and hit our 161.8% extension level as we expected. Okay. So in the next example, price recently broke out of the descending trend line. Okay, so we see it break out, and we're going for a buy entry at the 100% Fibonacci extension. Okay, once again, this is a Nike tick. I think you can see the tick a little bit clearer now. So we are expecting it, or we are projecting it to hit towards our take profit, as well as the 161.8 level. Okay, and you can see that's exactly what happens. So it does test the 127.2 level. So that's what we can kind of expect it to do. But ultimately, it would still hit our take profit. And it's not just by using the Nike tick or the Fibonacci extension strategy. We combine that with the upward momentum from breaking out of the descending trend line, and also from this buy entry uh, and the take profit, which are all levels of swing lows and swing highs. So pretty significant levels to take note of as well. Okay, next we're gonna move on to correlation, but before that, let me know in the chat if you guys have any questions so far. Seems like we're all good. Let's move on to correlation. So when you're swing trading, correlation can be a pretty helpful strategy by comparing two different financial instruments or assets. So could be your stocks, currencies, commodities, so on and so forth. Okay. I mean, of course, in this case, we are talking about forex. So you can compare um two forex currencies that you're looking at in order to see or predict the different directions that they're heading towards. So a positive correlation means that the two assets move in the same direction, and negative correlation means that they move in opposite directions. And for example, if the price of gold and the value of the US dollar have a negative correlation, then when the price of gold goes up, the value of the US dollar typically goes down and vice versa. So the perfect positive correlation is +1 and a negative perfect correlation is -1. So in order for it to be considered strong correlation, we look for values of 0.8 and above or below -0.8. So basically 80%. Okay, so what exactly is it in the context of Forex and trading? So traders will use correlation analysis to identify potential trade opportunities and manage risk. So if a trader holds a long position in a Forex currency, they may want to consider taking a short position in a negatively correlated currency to offset some of the risk of the long position. So it's important to note that correlations can change over time. So traders must continually monitor their relationships. Additionally, correlation does not equal causation, meaning that just because two assets have a high correlation, it doesn't mean that one is causing the other to move. Okay, so here I have an example. My FX book has a correlation table that you can use to find the most or least correlated forex currencies in real time. So yeah, I've highlighted the time frames. You can choose if you're looking at a higher time frame, lower time frame. It's all there for you to adjust. And you can find currencies with correlations higher or lower than a certain percentage. So we typically will recommend looking for correlations higher than 80 and lower than negative 80%. So you just have to put that into the filter and you'll highlight all of the currency pairs that match up with what you have requested, that you can see over here. So it's a very easy way of finding correlations. Okay, they have pretty much all of the major currencies as well as a couple of exotic ones. So you can go on to myfxbook.com and take a look and play around with the currencies on your own. There's another correlation table from CMC. Yeah, so just giving you examples that you can look at. So here are a couple of correlated currencies that are positively correlated. So we have firstly the AUDD and the Kiwi dollar, the euro and the pound, dollar index, CAD, and Swiss franc. Okay, so firstly we're going to look at the Australian dollar as well as the Swiss franc in this example. That is 84.2% positively correlated. So in this first chart, we're looking at AUDCHF, and this is what the chart looks like at that time in the 1 day time frame. And this is what the AUD chart looks like, also in the same time frame. So it's important that you want to use the same time frames to compare. And you can make use of the trading view feature that allows you to compare the charts at the same time. Okay, so yeah, so this is basically what it will look like if it is very correlated at that point in time. So you can see, yeah, whenever prices move upwards and downwards, it's basically about the same shape, I mean. Okay, and in this case, we are looking at pound dollar as well as the pound yen, and you can see that at this point in time, they are pretty much the same shape as well. So if you are analyzing the pound dollar, just solely by technical analysis, not taking into account any news events, any policy decisions, just by looking at technical analysis, if you analyze on the pound dollar, you can pretty much implement the same analysis for your pound yen, since they are pretty much almost the same and very positively correlated at this point in time, in this example. Okay, but of course things do change and it's important to look at your fundamentals as well, which is why before you do this, it's important to look at the MyFX book correlation analysis so that you know exactly how correlated it is. Okay, another example, Kiwi dollar and Japanese yen, as well as the Aussie dollar and Japanese yen. So you can see once again that it's very positively correlated. Okay, another example, Kiwi dollar and Aussie dollar. You can see it's pretty much the same. Yeah. So if you can't see, it is a little bit difficult to see just by comparing these two charts, which is why we like to use the trading view feature that allows you to compare two charts on the same chart. Two currencies on the same chart. Okay. Okay, this is another example. We're comparing the SPX with the euro dollar. And you can see they are also positively correlated. I think you kind of get it by now. So let's move on to negatively correlated. So negatively correlated currencies, some examples tend to be the DXY and gold, as well as the DXY and the Aussie dollar. So in this example, we are looking at the Euro Aus and Aus franc, which are minus 90.9% correlated. Okay, so this is the Aus franc. Okay, and this is the euro dollar. So you can already see that these charts pretty much look nothing alike, and you can see that's exactly correct. So whenever prices are dropping on our euro dollar Euro Oz, you can expect it to rise for our Oz franc and vice versa. Same thing in this example, we are looking at Oz dollar and dollar CAD. It's basically the opposite. Okay, and on the SPX and gold as well. So if you look at this chart, whatever you analyze on the SPX, just purely technical again, you can pretty much just reverse that for the gold analysis. So here is gold and US dollar, which tend to be negatively correlated a lot of the time. But of course, once again, remember to check before you do your analysis. Okay, and yeah, that brings us to the end of our webinar. Let me know in the chat if you guys have any questions, but if not, thank you guys so much for joining me today. Have a great rest of your week, and I will see you guys next week. Bye, everyone. Thanks, guys. Bye.